Welcome back to another UK property market update, guys. Today we're looking at June 2022. We are halfway through the year already. Isn't that crazy? Halfway through the year. I don't know where the time has gone. In our last video, we talked about interest rates and inflation. Inflation is on a cocktail of crack and Red Bull, guys. It's at its highest level in 40 years at 9%. And in parallel to that, interest rates are likely to jump. Today being Thursday when I'm filming this, the Bank of England are going to meet and review what the base rate should be. Interest rates are going to likely jump. Today, as I film this on Thursday, the Bank of England are going to meet and they're going to review the base rate. It's currently at 1%. I think we're going to probably likely see a rise to 1.2%. If they're feeling a bit racy, it's probably 1.5%, between one of the two. Let's see what happens, but something needs to be done about this crazy inflation rate. And we're going to today look at the knock-on effects on UK property, on the property market, especially for us millennials, right? What does it mean for us millennials? Because we're about the age when we start buying houses, first time on the property ladder. How is the current market, the current economy affecting us? So let's get into that, guys. By the way, guys, drop a like for the algorithm. It pushes this video out to more people, and subscribe if you enjoy this content. So let's get straight into some articles. In this piece by Property Industry Eye, we can see that lenders are going to find it very difficult to make money more readily available or cheaper to borrow going forwards. So let's talk about what they mean by this, right? So I, having worked in banking and credit risk, working with loans and all that kind of stuff, there is a link between banks and the Bank of England base rate. So when the Bank of England raises the base rate, so that has the effect of increasing interest rates across most other products out there. So for example, if you have a mortgage and you're on a variable rate, you might find pretty soon, if the base rate goes up, that your mortgage, your monthly payments are going to go up too. If you have a loan on a variable rate, you might find that the cost of that is going to go up as well. Same thing with a credit card and so on and so forth. Now, let me give you a little bit of quick insight as to why this happens. Now, banks, they don't have unlimited funds, right? They sometimes need to loan money from central banks, such as the Bank of England or other banks in what we call the money market, in order to have enough liquidity to go out and lend products to customers. Now that comes at a cost when they loan money from the money markets. So for example, if they're borrowing money from the Bank of England and the Bank of England raises their interest rates for that money that the bank wants to borrow, say it's Barclays are now borrowing at a higher cost from the Bank of England, and they need to pass on that cost to the customers. And what that looks like for me and you are higher interest rates on our mortgages, on our credit cards, on our loans, etc., etc. So that's a really high level explanation of how that works in practice. And then when we look at the UK property market data for June from Rightmove, we can see from this diagram here that rents in yellow and mortgages, this is the average monthly amount spent on a first time buyer home, are trending upwards. They're getting more expensive. But you'll notice that the level of steepness on mortgage payments, i.e. the green line, is a lot steeper in this last period than the yellow one, which is still rising but at a more steady rate than the green one. And that links into the fact that the Bank of England is raising interest rates to tackle inflation, which is having a knock-on effect on consumers like you and I. In this example, we're talking about mortgage payments, because of course mortgage payments are linked to interest, whereas rent is not. And guys, I said this last week, but I'll reiterate it again. Now might be, this is not financial advice, but now might be a good time to fix your mortgage. If your mortgage is coming up for renewal, or if you're buying your first home, I foresee, and I don't have a crystal ball, so don't quote me on this. I don't want you to come back to this video and put it in the comment section that you told me that interest rates are definitely going to rise, but inflation is at its highest level, guys. I have to say this over and over again, highest level in 40 years. And the way that the government tackles high inflation is through monetary policy, increasing interest rates. So I foresee over the next few years, we're going to see a steady rise in interest rates. So you might want to fix now before interest rates are higher a few years from now. Just a thought, something to think about. And then continuing with the theme of how us as millennials are positioned in the property market right now, this article from the introducer today, we can see that according to analysis from Direct Line Home Insurance, the average first-time buyer is spending $223,751 on their first property, which is 25% more than 6 years ago. I mean, we all know, if you've watched my videos, we all know now that on average, the property market doubles every 10 years. We've had a hard last 10 years. We've had Brexit, we've had Corona, we've left the EU. A lot of stuff happens. So not as high an increase as I would have expected, but 24% is still pretty robust, guys. But the point is, over the long term, property prices rise, okay? They keep rising. And the average first time buyer has to find £43,623 more than they did 6 years ago as a deposit. That is wild, guys. That is wild. To secure their first time property. When you work out that £223,000 deposit is round about roughly 7 times the average millennial person's salary. Now, most mortgage lenders won't lend above 4.5 times your salary. And I said it last week, but again, you know, if you're looking to put down a deposit on a house, especially in the south of England, it's more and more looking like that. The only way that that's possible is if you have a high salary, or if you're going it together with a partner or a friend or something like that. It is hard to buy a property, especially down south in England. Up north, it tends to be a lot easier. I was in Stockton-on-Tees in Middlesbrough, near Middlesbrough the other week. Up there, houses, you can get a 2-bed for as little as, you know, 70k, which works out to about 3 times the average single person salary. So huge differential between north and south. But on average across the UK, it's getting hard, guys, for us millennials to first of all save up a deposit, and second of all even qualify for a mortgage for a first time home. And as expected, London is the most expensive first time buyer market. No surprises there. Average price is £440,000, but it's a region with the slowest growing first time buyer market. It's only 7%, but it's a region where prices of first time buyer properties has grown the slowest in the UK, just 7% according to this article. Whereas other parts of the UK up north, in places like Burnley and Lancashire, the north coast of Scotland, East Midlands are growing over 40%, which, you know, softens that bit appeal a bit, but not really, because the average prices of first time buyer houses up there are around £169,000 compared to £440,000 in London. So yes, London is growing slower, but we're still talking 2.5 times the price of properties in these regions, even though they're growing faster. London is a bubble. Again, I'll say it over and over again. Always remember, guys, London is a bubble. So what is the net effect of that? Well, for people in the south, especially London, what we're seeing from this article, back to introduce it today, is that, you know, this generation of first time buyers, we are basically leaving traditionally popular areas like London and instead buying in places that are less well known, where you can get more property for your money, you get more space for your money, and especially with the introduction of remote working, you know, we don't need to live near our offices anymore. We don't need to live within an hour or 2 hours. I myself have worked from home for the last 3 years, and it doesn't look like I'm going back to the office anytime soon. So people are moving out of their city locations. They're going to more rural places that are cheaper, more value for money, and avoiding these costs. They're leaving London to the renters and the super wealthy. Not just London, but other cities similarly, where the locals cannot afford the average property. They're leaving and going in search of more value, more space, better quality of living. And then lastly, guys, let's look at what this means for the housing market overall. So interestingly, back to the property industry eye, they say that the housing market is slowing down due to inflation. Households have less money in their pockets. People in general have less money in their pockets as the costs of goods, utilities, petrol, everything goes up. However, in terms of the market, we're seeing that this article says that it will dampen enthusiasm, but it won't necessarily cause prices to fall, because demand always exceeds supply. It has in the UK for decades, guys. So agents, interestingly, the average estate agent has an average of 20 houses for sale, but near 400 buyers on their books. Now, I don't know if those statistics are necessarily true, but the overall point is demand in the UK still vastly outstrips supply. There is still a shortage of people putting their houses up for sale. There's a shortage of houses in general in the UK to fulfill demand. So even with what's going on in the economy with interest rates and inflation, there still is a surplus demand for houses. And as we can see here on this last graphic, the price of houses, the average price of a house in the UK, according to Rightmove, is still very healthily rising, and it has done since January, guys. You can't even really see a flattening of this curve, right? And this is because of the excess demand. So in summary, guys, increasing interest rates might be a good time to fix demand in the UK property market. So whilst we're seeing increasing interest rates and consumer confidence might go down, inflation doesn't tend to do good things for the economy, the property market is still pretty healthy, guys. I hope this video was helpful and insightful. If it was, guys, drop a like, subscribe, and I'll see you guys soon.